Welcome to Sara's Opening Bell. I'm your host, Sara Bryant, and each week I'll help you make sense of the markets. Today, we'll demystify initial public offerings, better known as IPOs. Whether you're new to investing or a seasoned pro, understanding IPOs is crucial, so let's dive right in. An IPO occurs when a private company decides to go public by offering its shares to the public for the very first time. This process allows the company to raise capital by selling shares to investors like you and me. Now let's explore the pros of investing in newly public companies. 1, their growth potential. IPOs often involve companies that are in their growth phase, and this presents an opportunity to invest in businesses with high growth potential. If you believe in the company's long-term success, investing early can lead to significant returns. 2, access to promising startups. IPOs provide access to startups that were previously only available to venture capitalists and institutional investors. By investing in an IPO, you can become an early shareholder and potentially benefit from the company's future success. 3, liquidity. Publicly traded shares are generally more liquid than private investments. This means that you can easily buy and sell your shares on the stock exchange, allowing you to convert your investment into cash relatively quickly if needed. Now that we've outlined some of the benefits, it is important to consider the cons as well. Here are some things you should consider before investing in a newly public company. 1, volatility. Newly public companies tend to experience higher volatility than established ones. The stock price can be influenced by market sentiment, investor expectations, and the company's performance, leading to potential price fluctuations and increased risk. 2, limited historical data. Unlike mature public companies, newly public ones often have limited historical financial data available. This makes it challenging to assess their long-term stability and growth potential, creating a higher level of uncertainty for investors. And 3, lockup periods. So after an IPO, company insiders, such as founders and employees, are usually subject to lockout periods. During this time, they are restricted from selling their shares, which can create an imbalance in supply and demand that potentially affect the stock's price. And there you have it. Remember, investing in IPOs requires careful research, understanding your risk tolerance, and diversifying your portfolio. So if you're considering investing in an IPO, it's always a good idea to conduct thorough research before making any investment decisions. And there's no better time than the present because markets are now open.